In one of our previous videos, we have looked at some important parameters in stock selection and the importance of gathering a complete picture before taking a decision on a stock. We looked at current quarter profit, previous quarter profit, as well as parameters such as asset base and their role in the stock price of a company. Now, some of the key traits of a fundamentally strong company is the efficiency in utilizing its investment or capital. Ratios such as asset turnover, working capital turnover, invested capital turnover, and many more help investors to get clear insight of the performance of these companies. Let us dig a bit deeper into these ratios. For ease of understanding, let us assume we have company A, which in its last financial year posted these: total assets of 24,000 crores, current assets 8,000 crores, property, plant and equipment 10,000 crores, current liabilities 3,000 crores, sales revenue 20,000 crores, and shareholder funds, which is 12,000 crores. Let us first look at asset turnover. Asset turnover helps us in analyzing how much of revenue is generated when capital is invested in its assets. To get to this ratio, we divide the revenue by the total assets. That means 20,000 by 24,000, 0.83. What this means is that we generate 83 rupees of revenue for every 100 rupees invested in its assets. If in the previous period this ratio was 0.68 and now it became 0.83, company A has improved its asset utilization in the latest period. Next, let's look at working capital turnover. Working capital is the excess amount of current assets over current liabilities. That means in company A's case, we have current assets of 8,000 crores and current liabilities of 3,000 crores. So working capital is 5,000 crores. The working capital turnover is arrived by dividing the revenue with the working capital. So in A's case, that would be 20,000 by 5,000, which is 4. Again, we should learn to study parameters with relation to past and current numbers, so that in the previous period, if this ratio was 7 and now it became 4, that would mean that the company has gone down in its working capital utilization. The previous ratios look at investment utilization by comparing the revenue with different asset variants. If some of us would like to know how a firm is utilizing its capital, we should look at the invested capital turnover. This invested capital is arrived by removing the non-long-term liabilities from the assets. So we arrive at total assets of 20,000 crores minus 3,000 crores of current liabilities, which give us 21,000 crores. The ratio is defined as revenue divided by the invested capital. So we get 20,000 divided by 21,000, which is 0.95. That means for every 100 rupees of invested capital, company A is able to generate about rupees 95 in revenue. All of these ratios are just some indicators on how best the company is able to use its capital. Higher the output, better is the utilization of capital in these companies. Like our previous video, make sure to put all of this information into perspective and assign appropriate weights to ratios like these when you evaluate companies. While these numbers alone are not enough to infer the complete picture of a company, they can be used greatly when comparing two different companies and trying to form an opinion. As always, keep watching us as we tackle more important parameters in the upcoming videos. Thank you.